line of credit or working capital loan. What's the difference? Business lines of credit and working capital loans are both great financing options, but they work in different ways. Many entrepreneurs don't understand when to use which. Picking the wrong one can mean two things. One, you don't have enough money, or two, you are paying too much interest. Let's have a look at both. A business line of credit is a type of short-term financing that you can use anytime for daily operating costs or during a cash crunch. It works like a personal line of credit or a credit card. You have access to a set amount of money that you can use whenever you need it. You can use the money, repay, and then borrow again without having to reapply for funds. And you're only paying the interest on what you use. Lines of credit are typically secured by accounts receivables and inventory. A working capital loan, on the other hand, is a typical term loan. It's a one-time lump sum that you get from the bank upfront and that you need to repay over a few years with interest. A working capital loan is usually used for projects that don't involve assets that could be used for security. These can include technology investments or marketing campaigns. Which one is right for you? Lines of credit and working capital loans are both important sources of funds for a business. They complement each other. It's not a matter of one or the other. It's more when and for what projects should I use a line of credit and when should I use a working capital loan. Let's have a look at their characteristics more in detail. Borrowing terms. Banks typically expect the line of credit to be repaid within a set period of time, usually 30 to 90 days. The working capital loan is a term loan that usually needs to be repaid between 3 to 8 years. How much can you borrow? For the line of credit, generally your borrowing limit is based on a set percentage of your account receivables. This is the money you expect to receive from your customers. And your inventory value, that is the value of the products you have in stock. Let's say that your account receivables is $100,000 and the value of your inventory is $50,000. Your financial institution has set the line of credit limit at 80% of the value of the company's account receivable plus 50% of the inventory value. This means that the amount available on your business line of credit is $130,000. One important thing to keep in mind when it comes to a line of credit is that your bank could demand full payment at any time. In banking, this is called demand loan. That could happen if you miss payments, if your business struggles financially, or even if the bank calls in the loan for its own reasons, such as for risk management purposes or because it is exiting certain industries. Check your terms of agreement so that you know what to expect. When it comes to working capital loan, since it's usually not secured by any collateral, a lender will look at various elements like your financial performance, your company's leadership, and your ability to repay the loan before deciding how much they will lend you. Working capital loans have a set interest rate, and the repayment period can be anywhere between 3 and 8 years. Which brings us to when to use one or the other. When to use a line of credit. A line of credit is usually used for short-term financing needs, such as day-to-day operating expenses, to cover temporary cash flow shortages, or pay for account receivables and inventory. If you're a business owner, you've been in this situation more than once. You have orders and you are making sales, but your customers take 30, 60, or even 90 days to pay you. While you wait for payments to come in, you need money to buy inventory and continue delivering on orders. This is a typical situation when a line of credit comes handy. Many business owners use lines of credit to cover seasonal sales variations, pay emergency or unexpected expenses, make inventory purchases to secure a discounted price, manage exchange rates or commodity price fluctuations. Big no-no. Don't use your line of credit for large or long-term investments. Using the credit line for such purposes can lead to cash shortages and affect lenders' perception of your credit worthiness. If you do that, when your credit line comes up for renewal, the lender could increase the interest rate, reduce the available credit line, or decline to renew. When to use a working capital loan. Working capital loans are typically given for specific projects to improve growth or profitability. Working capital loans are generally used to finance growth projects, especially those involving assets that can't be used as collateral or have no lending value. Here are a few examples: website redesign, marketing campaign, product development, technology investment, employee training, paying suppliers upfront to qualify for discounts, and market expansion. A working capital loan should not be used to finance the purchase of a tangible asset, such as equipment or real estate, which can be used as collateral for the loan. These kinds of assets can be financed with other types of dedicated term loans, such as equipment or real estate loans. The advantage of these loans is that they are secured with the asset you are buying, the equipment or the real estate, and as a result, you are paying a lower interest rate. Line of credit versus working capital loan. Which one is more expensive? The interest rate is usually lower in the case of a line of credit compared to a working capital loan. This is because lines of credit are typically secured by accounts receivables and inventory. A working capital loan, on the other hand, as I already mentioned, is usually an unsecured loan. This means it is riskier for the lender, so lenders generally charge higher interest rate to offset that risk. There you have it. Get in touch if you are looking for financing and drop us a comment below if you found this useful. And don't forget to like, share, and subscribe.